Tell us a little bit more about your investing philosophy. Like you're managing billions of dollars now, obviously. Had a really good 15 years. Like what are some of the trends you've looked at? How do you think about investing?
I know you and I have talked about this. One of the things that I thought was interesting stylistically in my first exposure to venture back in 99, 2000 is they were generalists. People would walk in off the street, two people and an idea. And it seemed like the office was always full of people doing kind of random things, frankly, from restaurants all the way through,
It's even today on Twitter, Paul Graham's like, you shouldn't actually say you're focused on anything because you should back the best entrepreneurs.
That's right.
Like a tweet yesterday. Yeah.
That's right. Yeah. I kind of, and maybe this was my legal training, maybe it's just my DNA, but I kind of consider myself more of a researcher and anthropologist.
You want to go deep on things.
Right, exactly. And so what I had, when I was studying the internet in 1998, 99 and saying, where will durable value accrue? It seemed to me there are a couple areas. And one was organizing all the world's knowledge and information. Another one was organizing all the world's products. Yep. So helping us find and buy things, helping us discover knowledge. And you could build effectively a tax collection machine that sat in front of those. So for a decade, I started and invested in search businesses, horizontal like Google, and vertical search engines like Leading the Series B and Zillow, or Faircast, or Sidestep, or Kayak, or Booking.com.
Makes sense.
Etc. By 2008, 2009, we had this thing called the iPhone, and we said, wow, something's really changing here. That's no longer going to be search first. That'll be, something else. And we saw these icons evolving on page one. And so how do you become an application? How do you truly leverage? So companies like Uber and Airbnb, companies that were taking advantage of the social graph like Facebook, that became applications and were no longer paying the toll keeper, the search engine, in order to gain access. And then I think we were early to the cloud. People forget, but in 2011, 2012, the cloud was not viewed favorably. And the reason for that is it was more costly, it was less performant, and it was viewed as less secure than running compute in your own data center. Yeah. We had a different opinion there. And so our fund, we run, as you know, a long short hedge fund and a long only hedge fund. And those are permanent capital. And now we're on our seventh venture fund. But back then, when I launched our first venture fund, it was almost all dedicated to the cloud. So early investments in Snowflake and Mongo, Twilio and HubSpot really powered the returns.
We were in the same wave. It took a long time to get the big institutions to actually trust the cloud, but it was clear they were going to, and that's where it is now. So, Brad, a lot of people argue today is harder than it was 10 or 15 years ago. I'm curious what you think. They say that, AI, it's a lot harder, especially for venture, to take advantage of that, given that the existing companies could do it as well. And so there's a lot of debates about what the returns the next 10 years are going to be versus the last 10 years. Like, what are the big trends today, and how are you seeing it?
It's not surprising that those arguments are reemerging right after 2022.
Yes.
Okay? Those same arguments existed in 2001 after that correction, and existed in 2009 after that correction. And ironically, as investors and thinkers, we tend to be overly influenced by the most recent events. So I actually think this is the best of time, the intersection when prices have corrected, but you're early in a super cycle.
Yep.
I think AI, or I like to talk about augmented intelligence, will be more important to humanity than the first three super cycles I've lived through, which are internet, mobile, and cloud. I think it'll be bigger. And so I don't buy that thesis. Of course, as Bill Gurley, our friend here in town, likes to say, venture capital is cyclical, right? We have not suspended the laws of gravity. Interest rates matter, right? And so that overlay matters, but none of that changes the never-ending waves of innovation that we drive in this country. And when you can get early in one of these super cycles, those tailwinds provide extraordinary opportunities for return.
So we're seeing a lot of $100 million, $200 million AI rounds, some really hot competitive stuff going on in the Valley. Is that what's going to be that makes the money, or how do you play AI?
Well, oftentimes, as you and I, again, have seen, is being early can be tantamount to being wrong. Okay, so think about 1998. Every venture capital firm in Silicon Valley realizes the internet's going to be big, actually realizes that search, organizing the world's information, is going to be important. And the mad scramble was on. Everybody wanted a search logo. Lycos, Alta Vista, Ask Jeeves, InfoSeek, go through the list.
Again, those logos maybe wasn't as good of an idea as it seemed at the time.
And here we are. You could have waited until 2004, Google's IPO. You would have captured 90% of the upside ever created by search, and you would have avoided all of those zeros. Remember, I talked about CMGI, started by David Weatherall. That company in 2000, he gave the graduation speech at Harvard Business School. He was on the cover of Time magazine. He bought the naming rights for Foxborough Stadium in Boston, renamed it CMGI Stadium, and was bankrupt a few years later.
I've never even heard of him. I was 18 years old at the time.
Because he beat out Barry Diller in buying Lycos.
That's funny.
Had Barry bought Lycos, it may have ended him as well.
Wow.
So I think being early can be wrong. That doesn't mean that the fundamental thesis was incorrect. In fact, it was right. Internet was going to be bigger than we all thought. Search was going to be bigger than we all thought. But you didn't have to be there and pay those high prices. I think we saw this in early mobile. Danger, Sidekick, BlackBerry, there are a lot, Palm, there are a lot of great mobile efforts before you really had the emergence of the super cycle. Same in the cloud. And so we're early in AI. We're seeing really interesting stuff in the tooling layer. We're investors in the public market, and NVIDIA's Silicon Layer has obviously been ignited because of this. We're going to launch more, we're going to deploy more compute in 2024 than in all previous years combined.
Yeah, the data infrastructure and compute stuff does seem to be a good play, obviously, the last few years. That's an amazing amount of money being spent there.
Right. And so, the condition required to participate in AI is you have to aggregate all of your data and you have to set it free and get it frictionless into the cloud. So we're seeing reacceleration in terms of that entire stack. But if this is as big as we all think it will be, this will play out like the internet did
there's lots
over
of
decades, not months.
So give us a crash course of your investment philosophy. Is this normal? You hold these things for a long time?
Yeah. My average holding is 42 years.
42 years on average.
Right, on average. I believe in getting to know management very well. I believe that the key to any great investment are the people at the end of the day. Sure, technology is important, but where does the technology
Doesn't management change multiple times during
sure.
those periods?
And sometimes you have ups and downs. For example, we sold out in 77, and there was a palace revolution at Lilly, and the guy that had been made CEO for a year got fired, Vaughn Bryson. And they brought in a fellow who ran a phone company to be the head of the company. Bryson got fired, and the guy that was there that should have gotten the job was Sidney Terrell, who I knew very well. And Sidney stayed, thank God, and Sidney finally did get the job.
But you held, even though it was the wrong CEO for a while, because you thought it'd be fixed.
I knew how I got to know the company. Well, by the way, when Lilly sold to me, they had a market cap of $2.5 billion, and they had sales of $2 billion.
It's pretty low market cap to sales.
And they gave us roughly 2.5% of Lilly for our company.
There's inflation in the economy, then things were valued really cheaply back then.
Yeah, but also, unless you had by the way, a big drug then was $100 million a year.
Wow.
That was considered to be a successful drug.
What's their big drug doing now? Is it GLP-1 stuff they're doing now? Is it biggest?
Well, I think that Mounjaro probably by 2030, the pundits say, probably will be over $30 billion a year, and well over $30 billion. The whole market now is up to 100, those GLP-1s.
Amazing. We're producing a few $1 billion for them with one of our companies right now, worth this stuff on the wholesale side. We're advanced biomanufacturing.
Oh, sure. Well, there's such great demand. They're in short supply, and that's them and Novo. Lilly, I think the profile on the Lilly molecule is far more beneficial than the Novo, but Novo's got a great product too. So anyway, I got it. I got to know the management. I got to know everybody in the company. I had enormous respect for them. I think they were conservative. They had a great balance sheet. And by the way, they had a nice dividend. So I took a company that was, by the way, IVAC, when I took control in 1972 in a proxy fight, had a market value then of $1.5 million.
Public company.
Public company.
$1.5 million.
Public by accident. The guy that was running the company, the guy that I threw out in the proxy fight, would take a packet of stock certificates and one of the devices they made, which is an electronic thermometer, and go to Las Vegas and go in the back where the band was and take out the thermometer, and he'd sell guys stock for $1 a share, $2 a share.
Crazy.
And that was his undoing because effectively we had to go in and register all those shares.
Then you have to go public when you have
Well,
too
we
many
were public.
shareholders.
So
Yeah.
for 5 years, we were public from the time we took control. But we got it cleaned up good. We put a good group of guys in to run it.
That's funny.
And it would. So anyway,
So if you put a good group of guys in, what have you looked for in management and leadership? What does that mean to you?
first of all, I look for honesty. It'd be the basic stuff. I look for honesty. I look for wisdom in terms of breadth of thinking. Are they thinking provincially or are they thinking globally? Are they thinking about the opportunities and the possibilities? The thing I loved about Lilly's research was they had a strong franchise in antibiotics back then. They had a significant animal health business. Ironically, they owned Elizabeth Arden, the cosmetics company, which they eventually sold. But more importantly, they made their mind up. They wanted to go into medical devices in a bigger way. So they bought a cardiac pacemaker company. They bought a defibrillator company. They bought a number of companies related to devices. Most of the devices, of course, were related.
So integrity, expansive thinking.
And also, Joe, were they willing to stick their neck out and take chances? Research in R&D in pharmaceuticals is a high-risk business. And you got to spend a lot of money to be in the game. Lilly right now, this year, I think their budget, R&D budget, is going to be over $10 billion.
They're still taking risks. They're still being bold.
Well, they're doing, and included in their research are the cost of clinical trials.
Yep.
So you can't make a claim unless you go through significant.
Of course.
They've spent a lot of money developing these products and applying them to new markets.
Yep.
And the results look very, the point is, it's always about the people. So my focus always has been, I'm not a scientist. I don't know molecule from a, whatever the hell else you want to call something scientific, but I know people and I have a pretty good nose.
What are you bullish on right now? Are there certain teams or certain areas?
Yeah, I'm bullish on a company right now called Option Care Health, at-home services, medical services. So for example, if you're a patient and you need a certain medication intravenously, they have pharmacies all over the United States. They ship the drug to the home for the next day. A nurse shows up the same next day,
That's amazing, yeah.
and the nurse does the administration there.
It seems like keeping things out of the health systems, you save a ton of money.
Well, you save money, but also it's safer. Lower infection rate. Believe it or not, hospitals are dangerous places.
The hospitals kill people by mistake.
Well, because the disease is in the hospital. That's what the hospital's there for. So they got a hell of a good management. They had a weak start, but the guys that came in to run the company have pulled it together, and I'm very excited about that. And I've already owned that stock now almost 5 years, and we've done okay, but I think we'll do a lot better in the future.
Amazing. I want to ask you a little bit more about what it takes to be a leader. Your father was a plumber. Your mother was a cafeteria worker.
Right.
Neither of them went to high school. You started working at age 11 or 12. How'd your upbringing shape you and help you become a leader?
I learned, for example, one of the things I won't take a back seat to is judgment of people. I got a pretty good nose for people. That talent or that ability became conscious to me when I was a caddy. And I'd caddy for people. There were two types. There were guys that if they had a bad shot, they didn't blame it on anybody else but themselves. And there were guys that if they had a bad shot, they're looking around, who's around that I can blame? And typically the guy that gets the punishment is the caddy.
The caddy, yeah.
But I learned close up, because these guys, don't forget, they think we're just mechanical. We don't evaluate, we don't observe, we don't do the things. I made it a point to studying the men I was caddying for and how they behaved and how they treated each other and how they talked to each other and how they treated the caddies. To this day, Joe, one of the things I love to do, if I'm being asked to evaluate somebody for a job at one of the companies, I like to take them to a meal. And I love to watch how they interact with a waiter or the busboy. How do they talk to them?
Yep.
What's the tone of their voice?
How do they value them as people, you mean?
Exactly. Do they have empathy? Do they have the ability to make a bridge? I know if you have a waiter that feels good about you, for some mysterious reason, whatever, the service is always better.
Yeah.
I'll be right back, or I'll bring you this, or I'll bring you, oh, you want this? I'm sorry.
It shows awareness of what matters to them, too. Yeah.
That's the whole point. That's their life.
Yeah.
And one of the things that really disturbed, I was having been in that category myself. You don't feel good when you're beaten up upon by somebody you can't fight back.
Yeah.
Because, that guy's going to give you a tip after your caddy. You don't want to tell him to drop dead, because if you do, he says, oh, you told me to drop dead here. Yeah, I'm going to stiff you.
Yeah.
Same with waiters. And where I get superb service, I like to reward them exceptionally.
This reminds me, I know the story of Home Depot is well known. You talk about it a lot, but it reminds me of how you talk about the managers and associates there, right? Tell us a little bit about that.
Well, I just had a meeting Friday. I took 25 store managers and district managers to lunch. I do it once a year.
At Home Depot, I still take them to lunch.
And I have them around in a big circle. We'll go to a nice restaurant. I let them off the menu, whatever they want. And we go around a room and we talk about what they like and what needs to be fixed and what's wrong. And you got to listen as much to what's wrong as to what's right, because if it's wrong, you got to fix it. But one of the things that comes through loud and clear, again and again, the positive side, the culture, how we take care of each other, how we care about our associates. I'll make a bet that of those 25 remarks from each one of them, I'll bet 75% of them focused on the culture. And that was something we developed day one. That was something we said, we're going to be mindful that the most important person in the company are the people on the floor of the stores, because they're the ones that interact with the customer. They're the ones where if they give the customer a great experience, the customer's going to remember the waiter.
I want to ask in general about your success as an investor. So you obviously, we talked a little bit about these companies you built and you did really well at them, but I think you're probably most famous these days is for someone who's invested in, I think, maybe dozens of unicorns. You've backed some really top companies from the beginning. You mentioned Stripe earlier. I think one of the famous ones. You kind of invested in them really early on and had been a mentor to those guys. Like how did you find guys like that? How are you able to keep winning again and again and again with these early stage investments?
Yeah, I think I've been super lucky on that stuff. I think a lot of the companies that I got involved with quite early was just because I was helping out people in the ecosystem. Like I was starting a company myself, and people just started coming to me either for advice, or I was a couple of months ahead of them, or we would help each other.
You just happened to help the really talented ones, huh?
Yeah, just fell into it, So I just fell into I'm the clown car in the gold mine or whatever.
No, I don't think that's the right analogy.
No, but I got very lucky. So I helped out a lot of these early teams, and they just happen to be some of the biggest companies. It's Airbnb, it's Stripe. Eventually ended up helping out Coinbase and Figma and Instacart and all. And it's been a great ride. Like,
what is it about teams, for example, like Stripe, that to differentiate them from others? Like, what about what guys running that company made them special?
Yeah, I've been kind of noodling on this. I had a conversation with some folks on my team yesterday, where I was just trying to brainstorm on what are there specific signs of truly outsized successful outcomes in terms of the types of founders. And I think a lot of it is just like, do you end up in the right product market? Is the market big enough? Is it growing? Is it dynamic in the right way? And so I think half of it is just you find the right market. And some of that could be luck and some of that couldn't.
But those guys are like, I mean, obviously, I know you agree they're special, but they seem like they're like some of the leading kind of intellectuals in our world.
No matter what,
right
you
now.
need the market, right?
Yeah.
Now, within that, there's tons and tons of people who enter these markets and do horribly, right? Yeah. And so what's different? And so I almost view it as there being three types of founders that become hyper successful. And I'm just testing this out or spitballing it, right? I don't know if this is correct. The first one is kind of the polymathic, hyper intellectual, yet very competitive person. And that's probably Patrick and John from Stripe. Honestly, that was Larry and Sergey when I worked at Google. They were very polymathic, very deep on everything. They'd go down into the weeds on the data.
Yep.
And so I think one almost like super founder archetype is that. Yep. I think the second one is the super hardcore, extremely focused, really, really driven overdrive founder. That may be, Travis from Uber.
That reminds me of like Peter at Wish back in the day, but when he was doing well.
Yeah, Peter was just super focused. And I think there's almost signals of those, because a lot of people in our ecosystem now, for example, are doing angel investing, or they're involved with lots of other companies while they're running their company. And that second class of founders don't do any of that. They're they actually say no to everything, and they're just all in on one thing in a really
Travis
big way.
is definitely that way,
Yeah, so I think that's another archetype. And there's a few people I can think of who just had massive success that I just view as incredibly focused, right?
I feel like Elon used to be more that way, because he really would say no to everything.
Yeah, some of the best founders are just like Parker at Rippling is incredibly judicious with his time. And he's just like, he's really focused. And then I think there's a third type of founder, which is just like the network effect business. And it's just, you have something that has network effects, you're going to do well.
Even if you're a clown car.
You could be, you could be Zuck, and then you take it to the next level,
That's
right?
fair.
And you start doing things like Llama and things like that. On
so
the
Zuck
AI
maybe
side.
has a network effect plus maybe some of the polymath side or something like that.
Yeah, or just I don't know him, so I don't know if he's on the intense focus or the polymathic side or whatever. But I'm just saying like maybe he's sort of an overlapping archetype of like one of those things. Plus, you now have a network effect business, so it's a default defensible.
Have you seen a lot of more network effect businesses recently? Because network effect is a thing we always talked about a lot in consumer, obviously, and those are giant companies in our world, and there's some in enterprise. But what are you seeing in network effects these days that are exciting?
Yeah, I'm seeing less network effects and more scale effects, which are related or overlapping, where as you get more scale, you end up with cost advantages that then allow you to get more scale. You could argue maybe Stripe is in that basket, but there's also more modern versions of that, particularly in energy and other related markets. So it's back to a broader question of how do you create defensibility in a business? And there's almost like 5 or 6 common patterns of defensibility. Scale effects is one, network effects is another. Creating an ecosystem on top of your platform, like what Salesforce has done, is one.
Yep.
There may be long-term contracts and durability of those contracts, which happens, for example, in the medical distribution world. So, there's in the world of business, there's like 5 ways or 6 ways to create defensibility, and roughly everything falls into those.
Yeah, at Palantir, we always try to create network effects, and we did get a few of them going. So we got a lot of countries working over it with dozens of countries where we kind of had to be on it. I think we were really proud to sell to Israel, and it was a big deal that they bought it because they never buy anything from anyone. But I think it was probably that network effect. That, I like to think we're just good enough, but I think that kind of helps, And then we had like Airbus using it with all of its suppliers, and everyone had to be on it. So I think there are enterprise network effects you can do, but they do seem to be more rare these days.
Yeah, I think so. And then there's also just the scale effects we mentioned. Like I know we were both involved with Anduril really early, and that's a good example where they now have such a broad portfolio of products. They have the deep customer relationships, and that allows a flywheel in terms of the ability to continue to cross-sell different types of products.
I think you get big enough too that you get a reputation in DC, and you can like do things in DC. You know what's crazy on Anduril one? So we have this company, Saronic. I think you're also just invested in that I help build, and it's growing really fast for the Navy. And they asked us to weaponize some of the autonomous vessels, and so we reached out to a few different primes. And Anduril was so good that like within 3 days, literally 3 days, we had the NDA signed, we had all the models, all the data, exactly how it works, sent it back to the Navy. And it was like it took multiple weeks even to get the NDA signed with like the other guys. And so it's kind of cool because the Anduril is now this thing that you can use as a prime. It's then making it grow even faster because everyone wants to work with it because it's the best.
Yeah, no, that is one of those sort of feedback loops that's very positive for some of these businesses. And so I think everybody always underestimates the degree to which these feedback loops end up mattering and the way that it changes the velocity and trajectory of a business. And if you end up on a positive track, it keeps going. And that's also true for hiring, right? There's certain networks that you tap into that keep the flywheel going. Somebody on my team actually went back and asked, are there common schools that all the founders of the biggest companies went to over the last decade, for example?
Interesting,
right?
yeah.
And there's basically 3 schools that are like a huge chunk of the overall value created. And then there's maybe 5 more, and that's very dispersed.
What are the schools?
It's kind of what you'd expect, at least for entrepreneurship. It's Stanford, it's MIT, it's Harvard.
Yep.
And then there's sort of the next set, which is like Duke, it's Carnegie Mellon, it's a handful of places.
Did Berkeley make it?
Berkeley's on there particularly for AI and blockchain.
I'm Stanford, but it's my rival school, so I'm curious.
Berkeley, actually, it's really interesting. Berkeley has a lot of PhDs in AI who've started interesting companies.
I actually have hired quite a few PhDs in AI from Berkeley.
Yeah, they're very good. And Databricks, so all the data, AI, et cetera, is like basically PhDs from Berkeley. And so there are these weird clusters or pockets of talent that go on to do interesting things. And that's actually been true throughout history, right? You go back and you look at the Renaissance, or you look at Paris in the late 1800s.
Like groups from some small town in Hungary will have like 10 of the most important mathematicians. It's crazy how it works.
Yeah, exactly. And that's true for art movements. That's true for literary movements, and it's true for technology movements.
That's amazing. At a basic level, what is macro investing? And what are strengths and weaknesses as a strategy?
Yeah, okay. So at the basic level, macro investing is just trying to, firstly, it's unconstrained. You can trade all assets in all countries, long and short.
You can trade Bitcoin, you can trade Turkey.
Trade whatever you want,
trade
really.
Rwanda.
But the commonality across, there's lots of different ways to execute macro. And the commonality is what you're trying to do is figure out what the macro scenario looks like ahead and how that is different versus what markets are pricing in. And
when you say macro scenario ahead, this is how the economy is going to do ahead. It's how the financial markets are going to do ahead. What does that mean?
Yeah, so it's any number of things. So different currency dynamics, growth, inflation outcomes, how that all translates to where we are in the cycle and how assets are reflective of that. There's a few different, at the high level, there's a few different things that matter. any asset, any market, any economy, all of it is just transactions that add up to that thing, right? So as like any individual human's behavior, if there's a bunch of humans in a company, their behavior adds up to the performance of that company. You can think about that, therefore, like any market, any macro outcome as being a reflection of those same sorts of dynamics, transactions that add up to the high level. All of those transactions are financed with something. So our particular lens in terms of looking at macro is understanding which flows of money, which flows of credit are coming from where and into what. What are people spending that money and credit on, and how sustainable is that? And therefore, what are the prices that creates? It's not just true in economies, it's true in financial markets. Where are the flows coming from that are going into US stocks? How sustainable are they? What's motivating those flows? Can we figure out when they're going to stop? And when they stop, what happens? Because if they're setting the marginal price, if that flow stops, some marginal weakness is going to happen as that price starts to reconnect.
And I think to outsiders, this stuff sounds like wizardry. It's really interesting, right? Because you think about it, you have to understand history. I mean, we'll talk later. You go back and you can go back very far and explain different things. You have to understand economics. You have to understand politics. You have to know how banks work, how central banks work, how normal banks work. You have to understand how markets themselves work in different ways. Like, are people in macro just like really smart? Like, you have to know all this stuff.
You have to know all of the high level stuff. But the thing that I like about macro is that, if you're investing in particular companies or stocks, you got to there's 30, 40 stories in your head at every level of the P&L that you're trying to remember about those investments.
You don't have to worry about this companies.
You just don't have to worry about that. And from my perspective, all that stuff, you don't have to worry about it because it's idiosyncratic. And then when you consider markets or economies at large, all of those idiosyncratic things diversify out and net out at the high level. So you're just saying, look, I mean, it's hard to predict what a particular stock is going to do because that particular stock is driven by a bunch of idiosyncratic things, their growth profile, their sector, and so on, and their strategy. But if you look at a diversified basket of stocks like the US market or any other global equity market, the vast majority of what drives the variability in those prices is some combination of growth, inflation, discount rates, and equity risk premium, or the multiples that people will pay. And that is all just a function of these flows that I'm talking about. So it's a sort of scientific way of figuring those things out.
I want to get into specifics so people can understand examples here. But before I do that, I did some macro with Peter Thiel when I was younger, and I really enjoyed macro trading. Some people I admired were people like Paul Tudor Jones and Stan Druckenmiller, who I got to know. And Stan, of course, returned over 30% annualized over 30 years on a very large amount of money. So a lot of people think that investing is random or luck or doesn't make any sense. Like, here's a guy who's a legend who just did this consistently without losing money for 30 years. So clearly it can be done. Are there people like that you've interacted with that you really admire in the macro world who shaped your thinking?
Yeah, I mean, the most important, the most formative were my CIOs at Soros, Scott Bessent, who's worked under Stan for a long time, and Greg Jensen as co-CIO at Bridgewater. And, like I say, they were instrumental in different ways. And I think to some degree, I always wonder if I just happened to land in the right place to learn from those two guys, or whether there was something sort of pulling me in that direction, in the sense that we think about things a similar way and have similar frameworks for investing. And so when you have a similar sort of base level of parameter, you can then learn a lot and interface really well on all the particulars and refine your expertise that way. But those two guys in my career have been, hugely impactful mentors and teachers for me.